In this episode, we're talking about the potential for a personal debt crisis here in Canada.
Thanks for everyone for tuning into today's episode. Today we're talking about personal debt, Canadians' personal debt specifically. There was a recent survey that came out that showed 46% of respondents of the survey are within $200 a month of being insolvent. So that raises some concerns.
Definitely.
Bank of Canada raised rates 3 times last year, bringing it to around 1.75%.
Yeah.
And then on top of that, Canadians right now have $1.74 of debt for every dollar of disposable income, which is higher than what the United States saw leading into the 2008 financial crisis. So definitely some things to think about and to consider when we're talking about debt.
Yeah.
So Grant, to get things started, how did we get here? Why are Canadians in so much debt?
Yeah, there's a lot of things that have gone into this, but I mean, I think the major contributor to it was the fact that interest rates went to almost zero back after the financial crisis, after 2008, and that was done to stimulate the economy back from a grinding halt back into where we're seeing it today. So. But with low interest rates came the incentive to use banks' money or borrow money instead of using your own money, perhaps, or instead of just being a little bit more careful with your spending, because the money was virtually free for a long time, and so from the personal perspective of interest, it made no sense to use your own money.
Yeah, of course.
You'd be far better off using the bank's money at a lower rate than even your savings rate or your investment return rate would have been. But that has led to the problem we're in. So I think the interest rate being as low as they were is the biggest factor that contributed to it. There's been a lot of other things as well. I mean, there's been some creative debt solutions out there as well. Particularly, we're looking at automobiles the other day. Most people, when you used to buy a car, would only ever get a 5-year term on their loans. Now they're getting 8-year terms, and the whole point of that was to stretch out the more expensive payments so that your monthly payments were lower. So now people are buying BMWs that never would have bought a BMW before because it's just on a monthly basis way cheaper. So the debt levels have just gone up because of that and more creative debt structuring. But by far, I think the interest rates is the biggest factor.
So with interest rates on the rise and the level of debts that we're seeing with Canadians across the board, what does this mean for the Canadian economy moving forward?
Yeah, really two things, two major things in my mind. The first thing I'll touch on is just the slowdown in consumer spending. As interest rates are coming up and people are already carrying a decent amount of debt, it just gives them that lowers their ability to continue to consume new products going forward. So a lot of consumables, like companies that sell things, might see lower sales going forward as people just have a lower ability to buy. And I'm not talking about like the staples, like the food and stuff like that. You're going to continue to have to do that stuff, but more luxury items or disposable items that you wouldn't, it's more for entertainment or things like that. You might see a slowdown in that. On a scarier note, though, what it could mean is interest rates rise and people, as you mentioned, 46% of Canadians within $200 a month of insolvency is a very scary stat. To think that if that many people, nearly half the country, was insolvent, what that means for the lending institutions that have lent them that money if they're not getting paid back. That's a little bit scarier. I think it's overblown that the Canadian banks are at really high risk in this environment. They're mostly insulated from these things, but it is certainly a concern. I mean, if people can't pay their debts back, the lending institutions will be the next to hit, and as we know in Canada, that has a trickling effect, a contagion effect, if you will, to other areas. So it definitely is a concern. It could cause a slowdown in our economy, which could lead us into a recession, and so we need to be very, very aware of that going forward.
So let's say I'm watching our video today, and I'm a person that understands and realizes that I have too much debt, too much personal debt. What can I do about it to avoid a catastrophe or a personal debt crisis?
Yeah, a good, really good question. There's no real fancy way of taking care of this other than you need to just plan for it and plan a debt elimination strategy around it. 2019, I think, is going to be the year that you should really, if you're one of those people that is carrying too much debt, 2019 is the year to take care of it in my mind, because it looks like interest rate hikes are going to slow down for 2019. Not saying we're not going to have any rate hikes, we might, A lot of experts are calling for 1 to 2 hikes maybe, but unlikely I think that we see 3 or 4 hikes. I think the economy would really have to take off to do that.
But regardless, time to start.
Time to start at this point to start paying those debts down. And so what you want to do is, if you can, try to consolidate your debts. If you have higher interest rate debts, consolidate them into a lower interest rate debt vehicle. A lot of people, if you're carrying a credit card debt at 20% or around there, you'll want to consolidate it into like a personal loan, or maybe even a home equity line of credit at a much lower interest rate. That's a good idea. You're going to pay lower interest overall. If you can't get all of your money into lower interest rates, then what you want to do is target the highest interest rate debts first, and then bring it down and pay those off, and then go to the next and the next and the next until you're all the way done. You want to have a back payment strategy on those debts, though. You need to start allocating a portion of your paychecks towards those debts. And this year, like I said, is the year to do it. Even if it means that you're saving a little bit less this year, I really think that this is the year to take care of it if you're not already.
Well, thanks for everyone who tuned in to today's episode. If you have any questions about debt or consolidating your own debt, always feel free to reach out to us. You can reach us at whitehoustonwealth@nbc.ca. Check out our website, www.whitehoustonwealth.com. And we'd be happy to hear from you.
Great. Ready?
Aim. Fire.